prepare yourself for the next market rotation. You guys know how important it is to keep an eye on market sectors. Just take a look at technology over the past few months. It's been the leading sector for a couple of years, and then boom, it's been falling out of bed, while other sectors such as the hard assets, commodities and whatnot have taken the lead. Today we're going to look at what the current market rotation is doing and what sectors you need to be in for the next move and what you need to be avoiding. My name is Keith Richards. I'm President and Chief Portfolio Manager at Value Trend Wealth Management, and this is the Smart Money, Dumb Money show, and because you're watching, you are smart money. We're going to start off with relative strength rotation. Now there's two types of graphs that I have used to illustrate to you guys on past videos: comparative relative strength and where strength is leaving and entering into various sectors in the market. This one is kind of a fun one to look at because it's called a relative rotation graph and it's got long tails on it. So let me show you what I mean. So we're going to look at one of the leading sectors. So you can see the two sectors that are leading are XLV, which is the spider health care sector, and XLU, which is the sector spider US utility sector. Now these are all US, and the rotation is in relative strength versus the S&P 500. So what this is going to show you is how these various sectors are doing against the benchmark index, S&P 500. Now each one of these little dots represents 1 month. And you can see, for example, with healthcare, that it's moved from a barely improving sector to right into the leading over the past year. So the move has been significant. Now I want you to look at this line, the red line, which is XLY, which is the consumer discretionary sector in the US, the spider discretionary ETF. Now, it moved in a fairly tight sequence. You can see the dots, the months were close together in relative strength, from a leading sector into a lagging sector, which is the worst category, over the past year. So it very nicely illustrates how sectors have moved and where they are in the comparative relative strength versus the S&P. Obviously, we want to be in stuff that's either improving or leading and avoid the lagging and the weakening side. Okay, now to make things easier for you guys to understand, we're going to look at the leading stocks and the improving stocks, which are the green boxes and the blue boxes for candidates. And we can see that it was, as we saw with my first example, XLV, the healthcare, which has had a huge move towards being a leading stock over the past year, or a leading sector, I should say. And the utility sector, XLU, is also in the leading group. The sectors, I should say, that are improving include the staples and real estate and energy. So we're going to look at all 5 of those sectors right now to see if any of their charts appear to us as technical people to be constructive looking stock charts. So let's take a look. So again, just for you guys who like to take notes on my videos, the leading sectors are healthcare, which is represented by XLV, utilities, which is XLU, and then the improving are staples, XLP, real estate, XLRE, and energy. So let's take a look at the 2 leading sectors that we just spoke of, which are healthcare, XLV, and utilities, XLU. And you can see that indeed, healthcare has been on fire. Talk about a move. Now, what I like on this chart is that there was an old high back in 2024, and that old high has been taken out. That means there's no overhead resistance, at least at this point, on this chart. There's lots of what I like to call clean air ahead of the trade, meaning that you're not forcing a purchase against sellers. It's had a reason to break out to new highs, and there's nothing about it to stop it from moving at this point. Now, if we look at the utilities, it's been on less of an angle, but it's been pretty consistent really since the beginning of 2024. And it's been in a nice uptrend where you get peaks and troughs all the way along, pullbacks largely to that trend line. And we're at one of those pullbacks right now. So to me, that looks like an ideal point to be looking at the sector whenever you get a pullback within an uptrend. Now let's take a look at the three improving sectors. This is the staples sector and the real estate sector on this sheet, and we can see staples, and I have mentioned this sector in the past, fairly recently in fact, that the staples are moving in a consolidation pattern. Now swing patterns or consolidation patterns are great for traders, not so much for long-term investors. You want to buy at support where the sector likes to touch down and then sell at resistance. It is about halfway through its support to resistance pattern. So I would only look at the staples right now as a short-term trade, maybe with 5 to 10% upside before the trade ends. It's not for everybody. So this sector, it's okay, but it doesn't interest me for the purposes of where's the money going. The next sector we're going to look at is real estate, and I'd make a fairly similar observation. In fact, it's been in a bit of what we call a triangle. That is a consolidation pattern. At this point, consolidation patterns like triangles can break out either to the downside, which is bad news, or to the upside, which is good news. Which way will it be? I don't know. So at this point, I would not be looking at the real estate sector either. The final sector in the improving category is energy. Energy consists of both oil and gas stocks. You can see on the chart that energy, the ETF that is, the SPDR ETF, is trapped under a lid that it has not broken since the beginning of 24. So that's 2 years of sideways action, and every time it gets to around current levels, it tends to decline. So to me, most of the story behind that resistance, that technical resistance, is oil and not so much the natural gas side. Oil has its issues. Let's say it's been trapped at fairly low prices. It's going to need a catalyst to break out, where nat gas definitely has a catalyst, and I strongly encourage you to go back to some of my prior videos and read my blogs at valuetrend.ca, because I have spoken quite a bit about oil. In fact, my most recent blog, available on the link below, talks about natural gas. I'm very enthusiastic about natural gas, and as I have been talking about over the past 6 months, it recently broke out. So far, so good. I see lots of upside. Problem with buying the sector, though, is it's a mixed bag, and if I were to talk about the sector, I would only be focusing on natural gas. So given the three improving sectors we just spoke about are kind of lackluster looking charts to me, I'm not going to be looking at any of the individual stocks in those sectors today, but I will be looking at some of the individual stocks in our two leading sectors. So let's take a look at that. So you can see how we've been narrowing things down. We looked at the sector charts, and after looking at the sector charts, we decided, gee, I don't like the look of the improving sectors, whereas sometimes I very much do, but this time it didn't work out that way. So I'm just going to narrow it down to looking at the two leading sectors, and they are, as mentioned, healthcare and utilities. Now let's look at the top 5 holdings in the first of our strongest sector indexes. XLV, the healthcare ETF, has a 40% weighting between these 5 stocks. You can see, for example, Eli Lilly has about 15% alone. So we want to look at all 5 of these stocks to see why we liked the index to begin with. And we're going to pick the best of the best by doing this. Same thing goes for the utility sector. Interestingly enough, about 40% of the weighting of that ETF is based on 5 stocks. Not quite so heavily as Eli Lilly, but you can see anything from about 13% right down to near 5%, making up close to 40% of the weightings. So let's look at all of these 10 stocks individually to see which ones have the most attractive charts by themselves. So starting with the top 5 stocks, out of XLV, the healthcare sector. We have Eli Lilly. No surprise. What a rocket. Broke out of a base and boom. Great thing to see. It's pulled back a bit recently. Might pull back some more, but as I like to say, breakouts be breakouts. Now, Johnson & Johnson, J&J. Uptrend. Higher highs, higher lows, off the trend line right now. Starting to pull back. It may retreat a little bit closer to that trend line. Something to watch. Okay. ABBV, consolidation pattern, a swing pattern, sort of like the staples we were looking at before, but something I would not buy yet as a long-term investor. I'd want to see it break out. However, you swing traders out there could be looking at this stock as a candidate. Next, UnitedHealth. Nice base. What a breakout. It's retreated right to the neckline of that base. Now, this company has its problems, I'm well aware. So we want to pay attention to that neckline, and if it shows positive movement off of that, it could just be stuck at the top of the range right now, which would make it a swing trader. But if eventually it breaks out, there's a lot of movement it could see if it retreats to old highs. Let's see if that happens, but it's one we should probably keep an eye on. Finally, Merck, MRK. We can see that the stock broke out of a small base, reached an old high of around $100, has retreated to that level, and if it can hold that $100, the old high, it would be worth taking a position. We need to see if it proves, but it's in the right sector and it's doing the right thing. Okay, now let's take a look at the stock charts of the top 5 from the XLU Utilities ETF. We're going to look at each one individually. I'll give you the symbols for the stocks, and then you guys can make assertions from there as to whether you like the charts as much as I do. So NEE, a consolidation pattern. What I like about this stock is it was a huge breakout. It moved parabolically, and now it's consolidating. If it breaks out of that consolidation pattern, it could be in for very good news because there's lots of clean air ahead. Now, CEG made a nice move off of a similar type of breakout, but now it seems to be failing at that neckline. I would avoid this stock for now, but if it breaks above, it could be interesting. Same with Southern Energy. It's really struggling. There was an old breakout. It moved quite nicely off that breakout, but now it's below the neckline. I don't think I'd be looking at this stock right now. Duke Energy has been in an uptrend. Kind of looks like it's breaking it. You can see a bit of support that may be breaking. It's too early to tell because that could just be a short-term spike. But if it manages to get above the trend line again, this would be one to watch. Finally, AEP. Possibly this and NEE are my two favorites on this group. You can see nice uptrend, no failures of support, pulling back a bit. I think this stock, if it gets anywhere near that trend line, will be a good point to be looking at. So I want to give you guys a couple of final steps that you need to do after you've picked your favorite sectors that we're seeing rotational strength, your favorite stock charts within those sectors like we just did. Now we need to do some more in-depth research. And the first thing we want to do is take a look at the basic fundamentals. Now, I don't have time to go over all the metrics behind fundamental analysis. So I'm going to point you towards a very good educational site. I have no affiliation with these guys whatsoever, but they're called eLearn Markets. And I stole this chart right off their site. It tells you the top valuation ratios to look at. I would probably discount the final one, but everybody knows you want to compare price to earnings ratios to others in its sector and to its past PE ratios. You want to look at growth as well. You want to look at price to cash flow, return on equity, which is where you're going to see the growth, and debt to equity. So this is just to make sure the company is sound and experiencing growth. Finally is dividend price ratio. I don't pay a lot of attention to that, truthfully, because some stocks just don't pay dividends. The most important thing that you guys can do after you've discovered stocks and sectors that are seeing positive rotation, positive relative strength, positive fundamentals, positive charts, is to understand what the catalyst will be to make that stock move further up on the uptrend or to break out or continue the breakout in the future after breaking out of a base. So catalysts can include things like a great earnings report that's released, new products and services, mergers and acquisitions, a new government policy that is allowing this industry or this company to excel, macro environment factors such as a positive market, positive news from the company itself, including management changes. That can be a big one. If they bring in a new manager after terrible performance and this manager has a good reputation for turning things around, that can make all the difference for this stock to go up. So I hope this video gave you guys some pointers on how to find the winning stocks, including what's strengthening, what's weakening, how to pick the sectors, how to pick the stocks out of those sectors, and then how to understand what's the catalyst that's going to move those stocks. So we'll be back next week with more ideas, and please like and subscribe to this video, and don't forget, comment below. Final thing, you got to make sure you look at the Value Trend website and subscribe to the blogs, because there's a whole lot of material that I don't cover on these videos on those blogs. See you next week. Hey, thanks for watching. I hope you got value out of this episode. Please like and subscribe below. We're trying to grow the channel, and it would really be doing us a big favor. I'm presenting ideas every week on trades that we're actually looking at Value Trend. And by the way, I don't just talk the talk, I walk the walk. I have been a portfolio manager for 35 years. And in fact, I was one of the very early pioneers in technical analysis here in Canada. On my website, valuetrend.ca, you will see a link for our online trading course. And this course is a complete money management system. I do encourage you to take a good look at that and consider taking it. I priced it extremely low because I want retail investors, that's you, to take the course and get value out of it. It's literally my 30 plus years of experience put into one complete step-by-step course. And honestly, I wish that I had had something like this when I was an early investor. It really will stop you from making so many mistakes. I also suggest you subscribe to our Never Miss an Opportunity program, which is our blog and our newsletter. There, you're going to get ongoing ideas, tons of charts, lots of trading ideas. And by the way, we never, ever solicit. We don't send you junk spam and stuff like that to try to get your business. It's for information, because part of my passion is to teach retail investors how to invest properly. I've been doing this, as I said, for 35 years, and I hope that I'm able to pass on some of the things that I've learned through this career as both a pioneer in technical analysis in Canada and a longtime portfolio manager. Thanks for watching. Don't forget, push like, push subscribe. See you next time.